I'm Tim Harris from Morrison and Foerster. For the last 20 years, I've been representing entrepreneurs and angel and venture capital investors in their companies. And today I'm going to talk to you, give you a couple of opening remarks about innovation before we hear from our speakers. And in the course of my law practice over the last 20 years, I've learned that innovation is a natural phenomenon that occurs independent of marketplace cycles. That is, innovative entrepreneurs will start inspired companies in downturns just as frequently as they will in upturns, because their innovations are inspired by a confluence of market forces, technological development, and real-world problems, as opposed to merely availability or cost of capital. Quite simply, innovation comes from entrepreneurs who are willing to see the same things differently than others. Well, during today's session, we'll hear from a number of business innovations from companies that are worthy financing prospects. But I want to first comment on a few innovations in the financing environment that are affecting tech-based companies, including those in Israel. Now, for much of my 20 years in the Silicon Valley ecosystem, there's been a fairly well-understood financing path for promising startup companies. Promising startup will first rely on friends and family for its initial seed stage capital, then angel investors, then venture capital investors, and ultimately, after a couple years, the company would aspire to an IPO. The IPO was considered the ultimate liquidity event. Successful entrepreneurs aspired to bringing their companies public, which was regarded as creating significant value for the company and all of its stakeholders. During the years leading up to the dot-com bubble, there was a relatively high volume of IPOs, each of which raised a relatively small amount of capital. Of course, market structure changes, regulatory changes, and other developments led to the decline of smaller IPOs and affected the IPO marketplace negatively for a number of years. Now, even in the aftermath of the Jobs Act, it's possible to say with some degree of certainty that the capital raising framework of the United States has changed. And for the most part, with a few exceptions, the IPO has lost some of its luster, and many issuers are waiting much longer to go public. That's due in part to the now commonly held view that larger companies with more visible and more predictable earnings trajectories and higher market caps make better public companies with securities that trade better in the public markets. But there are other factors that also contribute to the decisions to delay or even forego IPOs in the US, one of which is the high cost of SEC compliance in the post-Sarbanes-Oxley and post-Dodd-Frank Act world. Now, many private companies that could bear these costs are deterred from becoming public by the rise in security class holder litigation, class action litigation, and securities law reforms that have criminalized a range of securities laws infractions that previously were treated as civil matters. Litigation is invariably expensive. Finally, once a company does go public, it loses a measure of operating flexibility because it's thereafter required to report earnings on a quarterly basis. And the pressure to produce earnings that will satisfy research analysts and institutional investors can often tilt corporate decision-making processes in the direction of favoring short-term results over more strategic, long-term thinking. We also see this phenomenon play out with activist investors. So it's easy to see why this might create enthusiasm on the part of senior executives of successful private companies to defer going public as long as possible. Now, several important developments now permit successful private companies to remain private longer, all while continuing to finance their activities through the private capital raising marketplace. A number of changes in the US securities laws have taken the illiquidity that was once associated with restricted stock that was issued in a private placement to be significantly increased. The shortened Rule 144 holding period, the ability to sell restricted stock privately through a variety of means, the safe harbor created by the RAISE Act, and the development of many varied exempt offering alternatives have contributed to this. The Jobs Act also made it easier for companies to remain private longer without fear of inadvertently tripping over the rule that requires companies with a specified number of security holders to become reporting companies. So it's interesting, an interesting counterpoint to the Jobs Act and its IPO on-ramp provisions, that in the last couple of years we've witnessed a dramatic rise in private capital funding volumes globally. More and more investors are entering into the pre-IPO financing market in the quest for outperformance. Now, the existence of these late-stage private financings, what we call pre-IPO financings, involve participation from a variety of non-traditional investors, at least non-traditional for Silicon Valley. And it's an important change in the marketplace that is not showing any signs of being temporary. A few stats. In 2015, global private companies across all industries raised $90 billion from investors, up 25% from the prior year. There today are almost 150 companies in the Unicorn Club that have a total valuation of over $500 billion. Now, at the height of the market in 2015, there were an average of about 10 companies per month that were announcing billion-dollar valuation funding rounds, according to the Wall Street Journal. And the largest 10 2015 pre-IPO financings raised nearly $11 billion, with a combined valuation of over $120 billion. So these private funding rounds have had a profound impact on the US IPO market in 2015, most dramatically demonstrated in the tech sector. Tech IPOs declined significantly to only about 22 IPOs in 2015, down from over 50 in 2014, while conversely, private capital raises in the US increased almost 30% to over $50 billion. So quite simply, the late-stage private round has become the new IPO. Companies that in the past would have executed an IPO at their current scale are waiting longer to go public, instead raising large late-stage rounds. Also significant in the growth of these pre-IPO financings is the fueling by not only traditional venture capitalists, but the new investors that I mentioned earlier. A lot more crossover funds, mutual funds, hedge funds, sovereign wealth funds, and family offices that in the past have required public market liquidity for their investments. Thanks to the many forms of exempt and hybrid offerings that exist today, these investors that are new to the private marketplace can obtain liquidity for their investments even in the absence of an IPO. So the universe of private investment opportunities is varied and extremely large, and there's an extraordinary number of innovative companies, especially in Israel, that will benefit from these changes and these innovations in the capital markets.